So I'm pleased to actually introduce a good friend and a great CPA, Dale Glasser, today. And it's one of those situations where I've known Dale for over 30 years. And when I first met him, he's like, oh, hey, why don't we get together, go play some golf? And I'm thinking, okay, go play 18 holes with my CPA. I don't know how exciting that sounds. And I get there, and the guy's wearing his black tank top, shorts. I got a beer in his hand. I go, this is going to be a lot of fun. So anyway, Dale's background, he's been CPA for ages. He was 15 years private practice prior to joining Eisler & Company. And he's one of the partners there. He specializes in a lot of assisted living care facilities, professional athletes, and we've done a lot of real estate over many, many years together. And a lot of the companies we've worked with actually use 1031 to build their empires. So it's been fun to do things with him throughout the years. He lives here in town, and his wife also too in Estacada. They woke up and saw the beautiful mountain this morning. Lots of sunshine. That's always a great way to start the day here in Oregon. But professional focus includes his expertise in three primary areas of service: proactive on-site and off-site consultation relating to tax, financial, and business matters for closely held entities, consultation for healthcare industry, financial and tax management for high net worth individuals and professional athletes. Dale has served as professor at Mount Hood Community College, is active in his community, and is member of the board of directors in Vital Life Foundation. He and his wife Linda enjoy traveling and golfing. Dale has a love for nature and people, and he really does. And I guess, anybody that is working in the world we live in, I always talk about a team of professionals and a good, competent tax people, somebody that you're going to pay for an opinion, not pay to learn on your behalf, is critical to your success. And it always makes me feel good when I'm dealing with a client that actually has tax counsel, and it just makes my life a lot easier to understand, to build talk with people that have people they can bounce things off of. And especially when we're going after more aggressive transactions, I want people to be working with good tax people to defend what's going on and justify it. Dale's one of those people. So without further ado, Dale, I'd like to hand the podium to you, and I look forward to hearing what you've got to say, and it's going to benefit all of us. Thank you.
Thank you, Dave. Thank you. Thank you all. I'm not sure I'll be standing here at the podium while I'm speaking. I like to walk around, and I do have kind of a loud voice, so if you can't hear me, wave at me, and I'll wave back, and we'll all be friendly here. It's a great turnout today. I've got to think that this must have been a mandatory meeting that you guys had to come to, because I can't imagine everybody would come to a luncheon today with beautiful weather out there and want to come and listen about tax law and the changes to the tax law rather than being on the golf course. Knowing, though, now that under some of the new tax law changes, golf is no longer deductible. So we're just going to have to call it something else. There's oranges and apples, and we're going to figure out a way to blend them all together. So I've got two other professionals here with me today. Rob Riley, one of my partners. He's been with us for about 14 years. 17? That's how fast it goes. I hired Rob 17 years ago, and he's come up through the ranks, and he's a great partner and in charge of our tax department. So I got to thank David for all the compliments he gave me, but be quite honest with you guys, you're only as good as the people you surround yourself with. And I'm fortunate to have Rob and my other partner, Stephanie, as well as about 30 other employees that help us get through all the menagerie of tax law and challenges that come along with blenders and banks and regulation and requirements. So we've got a great team, and we really enjoy working with people and being involved in their lives so that we can help them meet their goals and get to that next step. Another gentleman here, Chris Tenen. He's been with us for on and off now for probably about 5 years, and he left. He worked in Vancouver, and he left for a bit and decided that he didn't like it where he went, and even though it was close to home, and so he asked to come back, and we're glad he came back. So thank you, guys. As you know, tax law is ever-changing, And I'm sure you all have kids and grandkids that you play games with, and just about the time you think you're winning, they change the rules on you. And so what we're dealing with now is quite a bit of change in the tax law coming up, most of it beginning in 2018. So what we've got here is a PowerPoint presentation. You can follow along with the literature that we handed out. In that literature, we show you okay. You got it? Okay. Oh, I can walk around with this one? Okay. Thanks. So we've got the pre-act law, and then we have the new law, okay? So we're not going to dwell on the pre-act law. We're going to talk about the new law, okay? So the first topic we have here today is Section 179. And I think most of these topics that we're talking about, this is pretty much directed to what's going to impact your lives and how your clients and the industry is going to react to these new tax changes. But all in all, I think it's been really favorable to the real estate industry as far as some of the changes that they have made. And basically, it's about depreciation. So under Section 179, you can see there that we can expense up to $1 million worth of improvements in any particular year, just as long as your overall acquisitions are less than $2.5 million. And a lot of that now has been, there's real property now that qualifies for Section 179. And so with help of the people with, like Jonathan, when we start looking at what we can take now under Section 179, it's pretty powerful to understand how much you can really deduct in any particular year. So as you read along here, you'll see that roofs, heating, air conditioning, all of those things that we used to fight about, go to court about, now are pretty much laid out there and saying, look, we're done fighting with you guys. We understand it. We understand what it takes to get this stuff done. And we're going to play friendly with you at this point. So I think from that standpoint, whether they're existing buildings or new buildings that are going up, it's going to be important to really look at the components of each structure so that we can maximize the deductions and on the cost segregation side. So one thing that isn't in there is the with a building is escalators, elevators, and any structural improvements will not fall under Section 179. They will follow the lives of what they normally do follow.
You're feeling tethered to the podium here, so yeah. We're going to clip this into the lapel for you.
Okay.
You can stick that in your pocket.
Okay. Great. Any other tips?
Smile.
Okay.
Don't sit on
Thanks, David. Thanks. Then we move from Section 179 to depreciation, bonus depreciation, which basically, in a sense, mirrors Section 179, but the tax attributes of that and the type of properties that qualify that are somewhat different. And if and when there's a disposition of the property, the recapture rules can be a little bit different. So, but all in all, the power of these two opportunities are pretty substantial for real estate, okay? So, and you can use these somewhat in conjunction with each other. You just have to look at the class of the property, how it's classified as what type of property, and just make sure you're making the elections for the same type of property. You can't have one type of property be 179 and then the other part be bonus depreciation. So that's just a nuance that you guys don't have to worry about, other than to know that we have great opportunities, and those are even accelerated more so than they were in the prior year. Chris, do you want to talk a little bit about automobile depreciation?
So we have change in auto depreciation. We finally get some rules that are a little bit more realistic. The deduction goes from, it used to be really bad. Let me get to it here. We used to only be able to take 3160 in the first year, and now we actually get to take 10,000 and then 16 the second year. Makes it more realistic for cars. And that applies to all passenger vehicles less than 6,000 pounds. And then if you take the bonus depreciation, that didn't change. You still only get 8,000 to take with that.
Okay. So all of these fancy cars everyone has make it a little bit more tolerable to be able to afford them and to be able to get your write-off a little bit quicker than you have in the past. The only negative about automobiles at this point in time, especially with you folks that are collectors, is that you no longer can do a 1031 exchange on them. No personal property 1031 exchanges going forward after 12/31/17. Okay. Please, if anybody has any questions or thoughts or comments, feel free to raise your hand and ask any questions or anything particular application.
So it's just for business and investment cars?
Yeah. Yes. Yeah. Yes?
Anything change on the over 6,000?
No, that's the same. That's the same. So those are home runs, right? Yeah. The question is what about manufactured homes? Are those personal property or are they real property? And manufactured mobile homes are personal property and will not qualify for 1031 exchange. Unless, David, you know something that I don't know. Correct. Yes. Everybody hear that question? So if you have land and you have manufactured homes on it, you can do a 1031 exchange on the land component, but not the manufactured home component. So if you're structuring that transaction, where are you going to put the value? Right where it belongs, actually, because manufactured homes really don't hold their value. So you're going to have very little get allocated to that personal property and majority of it to the land. Well, if it's a, he's asking a question about long-term leases. If the lease is longer than 30 years, it's real property. So that hasn't changed at all. Okay? Okay? Yes?
Yeah, on the luxury automobile depreciation, whether it's 10 grand on the first year or 10 grand plus 8 on the bonus, is that including or excluding with the mileage though? Is it one or the other? Did you expand on
Sure. You're talking about the standard mileage allowance? Okay. The standard mileage allowance is an alternative method of depreciating or taking deductions for a car. So I think, Rob, tell me, it's 53.5 cents now this year? 53?
It's 54.5.
54.5 cents per mile. Okay. So if it's a new car, then you want to look at the cost, what type of car it is, what kind of gas, the value of that. And then we take a look at how it's being utilized and what is the best methodology to use to get you the best, quickest deduction. Okay? And then also what you plan on doing with the car and how quickly you flip your cars, or if you're a buy and hold type of person, will come into play. We used to be able to do 1031 exchanges for luxury automobile, any type of car, but now we can't do that. So the Section 179, the 10,000, the bonus is different, totally different calculation than the standard mileage allowance. One or the other. Yes. Yep. Good questions. Anything else before we move on? Okay. I think this is we've touched on this a little bit. Under the qualified leasehold improvements, it's now called it's QIP. It's qualified improvement property. It's no longer called qualified leasehold improvement property. And so what they've done is they've basically taken all the different groups of improvements to whatever type of businesses they are, whether they're apartments, restaurants, commercial, Class A space. They've called it all qualified leasehold improvement, or qualified improvement property. And they've just condensed it, making it easier to put everything in one bucket, so to speak. And those will qualify for 15-year write-off, as well as for bonus or Section 179 on most of those. So, and once you have a building that's in place, the old rule used to say that those improvements would not qualify unless the building was in service for at least 3 years. Now that has been taken away. So if you purchase a building and you're going in and doing some improvements to it, you may be able to get those written off in the year of the improvement. So, and I'll talk a little bit later about how when you do a project like that and you're using leverage, the power of the cash flow not going out but the deduction being up front is pretty substantial. And there are some limitations going forward about how much interest can be deducted in any type of business, and we'll get to that in a little bit. But the ability to do that without putting out cash and getting a straight up deduction is going to be really advantageous to the industry, as well as in effect increasing the return on investment after tax. So the business interest deduction for you folks here, basically what they're saying is if you have interest, which we all do, in today's world interest is pretty cheap, money is pretty cheap. If you can get it fixed, you want it fixed as long as you can. And we're probably going to be in an inflationary cycle here coming up, it looks like, as well as interest rate hikes. So the sooner the better you can get some fixed money for as long a term as you can. I think that's going to be the solution to this. So when the rule kicks in is if a company, no matter what type of industry they're in, has over $25 million in gross revenues, then the 30% restriction comes into play. So if you have a bunch of folks that have real estate, and what I haven't seen yet is, and Rob or Chris chime in here, or Dave, whoever might have some input here, you guys have probably heard a lot about this tax law since it came through, but what if I have single asset LLCs and I have 25 of them and they each bring in $1 million worth of gross receipts? Am I over 25 million? And am I subject to the interest deduction limitation? So I haven't seen anything on that yet, but my gut feeling would say that no, it stands on its own, unless you have a holding company that's rolling them all up. So there could be a lot of planning there. I mean, single asset LLCs, as you guys know, is really the way we want to go anyway. We don't like to commingle collateral and have that risk out there, as well as a lot of times the interest and the ownership will be different. So something to keep in mind when you're looking at that in structuring transactions for some of your bigger hitters and the property they have. And in fact, it may be something you have to look at now about how they're structured currently and if this new law could impact them on a go-forward basis based on the type of entity and how they're holding their assets currently. Okay. It's been a pretty good economy here the last 10 years or so. Does anybody remember the word net operating loss? That would be a no. So that's good. That's good. But net operating losses used to be able to be carried back 2 years and then forward. Beginning in 2018, you have to carry them forward. There's no carry back. And they'll be limited to only 80% of your taxable income. So we used to be able to carry them back, pick up old years, plus carry them forward, especially in 7 and 8 and 9 when people were taking some big humps and dumps and getting kind of beat up a little bit on that. So. As it flows through to the individual. To the individual, yes. Yeah. Yeah. I don't know how many of you folks got involved, but I'm sure a lot of your owners have manufacturing facilities, industrial facilities, and they had what was called the domestic production deduction. And that was to incentivize manufacturers in the United States to get into manufacturing, and for that, you got a 9% deduction. It was a federal rule. Oregon never attached to that rule, but that's gone now. So just something to let you know that it's been replaced by, I think in some ways, what Rob will talk about here shortly is Code Section 199A, and that is the 20% exclusion of income for federal tax purposes that potentially could make up for that, as well as maybe even sweeten the pie a little bit on that front. Okay. Like-kind exchanges. You guys probably all know this, but we talked about it a little bit earlier. No personal property. I think if you started those transactions before 12/31/17, they're not complete yet, you're fine. But going forward, any new transactions, you can't play that game. So I kind of was talking with Jonathan and David earlier, and we start now thinking about cost segregation. And what did we do 5 years ago with a piece of property, or 8 years ago with a piece of property? And Jonathan did his job. It may have ended up with a lot of personal property through that. Now we sell that property and do a 1031 exchange. How are we going to, we're going to be stuck in a situation where I can't get around that allocation. So knowing that it won't qualify for the exchange, we know there's some hidden tax cost in there if we do move forward that we wouldn't have really recognized in the old rules, under the old rules, okay? So it's very important that your clients understand that and don't have any sticker shock when they get their tax bill. And like David said, working closely with their team of advisors. And that's going to be a really hard thing. I'm sure Jonathan has already probably identified some of the clients they did cost segs on and are probably doing some things in a proactive fashion to look at that, understand what the law may look like, and then how we're going to work around that as you move into another piece of property. Whether or not you don't want to be in that state anymore, or that property has got to its highest fair market value, and it's time to take those assets and put it into something that has a higher growth rate than what my current property has. So, Jonathan, if you want to speak a little bit about that and how you guys are reacting to this. And
right now we're seeking clarity with the IRS because it's really, really gray right now about how the IRS is going to look at 1245 section called personal property in 2018. So I've been instructed not to comment on it until we get clarity. We have with the IRS on it, and I don't mean to sound like an attorney, I'm saying that it depends. But right now it's really ambiguous about how it's going to be treated and how it's going to be looked at. And we're working very diligently to find out and come out with a white letter on it. And right now we're still in contact with the IRS to seek clarity on that. How, with this 1031 exchange, how are you treating 1245 property? Because with this new tax reform act, things could change. So I don't really have anything to offer on that. You might want to remind the audience, but how did they get to the bonus depreciation deal, and how they can take advantage of that on the acquisition.
Yeah, and that's where Jonathan comes in. And he's very coachable too. You know, we've done a couple of transactions with him, and he adds lots of value, but he also listens to his audience as well. So usually we know where we want to get. Sometimes we just have to figure out the best path to get there. And so all those interactions have been very positive and with great customer and client satisfaction on those fronts. Yeah. Any other questions, thoughts, concerns at this point in regards to like-kind exchanges, improvements to real estate, how it's going to affect your industries? Is anybody seeing anything out there from your clients about how they're reacting to this? Maybe they don't know enough about it, but what kind of guidance are they looking for to try to help them make decisions about what they're going to do? Any real-life stories that anyone wants to share?
Dale, Doug probably echo it. Our personal property clients, they're obviously looking for some other alternative. The heavy equipment guys, the rental car guys, all those guys with the full expensing. So you're realizing the gain, the full expensing of the acquisition. Can you elaborate on any of that at all? Or you
Well, so I buy a $100,000 skidder, for my logging business. Is that what you're talking, David? Yeah. And the first year I can take 100% bonus depreciation on it, or Section 179. Whenever I do sell that asset, then whatever my proceeds were from that will be 100% gain and taxable at that time. So if you're in a growth mode, and whatever you're acquiring, if you're in a growth mode, you can kind of stagger it so that your acquisitions are greater than your retirements, so that you don't feel such a blow from that that depreciation recapture or that gain from sale. So, but knowing that you got your deduction way up front, okay. And I can buy a piece of equipment for 100 grand, and a lot of these people, they may finance 100% of it. So the time value of money plus the stretch on the payout, when I start looking at my internal rate of return, it's pretty positive when you look at it from that fashion. And when you're talking about durable equipment, those lives are pretty long, so it's not like technology is going to force them out and you're going to recapture it earlier than what you might want to because of obsolescence. So depending on the type of equipment, though, yeah, you can come right back and kick you in the butt, but it's all about timing, right? And it's all about getting that benefit up front and hoping that rates will be a little bit lower when you do sell. Yes? As far as capitalization? Normally what we see is on anything like that, it may be a lease, but it's really a financing lease. So you end up capitalizing it, and then you expense it that fashion. If it's a straight operating lease, then you would just expense that lease as you pay it out. But those end up being hard money leases, right? Yeah. Okay. And since nobody has net operating losses anymore, hopefully no one has to do hard money lending. That's why the bankers are happy too. So, yes, sir.
Who benefits the most?
Damn good question. Let me ask you guys this question. How many of you guys think you're going to win under the new tax law?
You told me I'm not.
Come on, you guys, be optimistic.
Yeah. Well, yeah, it depends. But like I said, the real estate side, I think you guys may win. I really do. Other folks that don't have the real estate holdings, yes.
I guess I would just say that many of us in here are professional service people, just like you. And so I hope that we're going to get into, sort of our, you're talking about a real estate investor, some of us are.
Mm-hmm.
A lot of us are just service providers.
Sure.
So I'd like to hear that part.
Yeah, and Rob is going to hit that one right on the nail head. Okay? Okay. But if you guys are really successful, which I'm sure you all are, you may not get any benefit for it because the IRS says you make too damn much money. And their definition of making too damn much money is totally different than ours. Okay? So, but Rob will go into depth on that point. I saw somebody else's hand up. Yes?
I had a question on the change to carried interest. So now you have to ask for 3 years in order to capital gain.
Mm-hmm.
So I'm wondering how that can be saved if you're a developer. Other projects, like 2 years down the road,
Well, I think if you disposed of the property, yeah, I haven't looked at it, but I would think the holding period is longer than a year. So I think if you disposed of the property in less than 3 years, that it would qualify. But I'm not sure. But if I can get your card, we'll get you an answer. Okay, it's a good question. Okay. Okay. Rob Riley is going to talk about Section 199A and the 20% exclusion to income. So.
Yeah. First, I wanted to just mention about, I don't know how many of you follow the state of Oregon and what they're doing right now, right? They're having a legislative session, a short session for this year. One thing that people kind of forget about sometimes is that Oregon has their own rules when it comes to what they're going to do for tax laws, and most states actually follow the federal laws to some extent. So, but when the federal government makes a big dramatic change like this, Oregon and other states have the opportunity then to think about whether or not they're going to actually follow what the federal government's doing. So right now in the short session, they have a reconnect bill, which is what they typically do every year. They decide when they're going to connect to federal law, or if they're going to even connect to federal tax law. So I don't know where they're going to end up on that. So one of the things that we have to take into consideration, I think, is that there is in the past, they have disconnected from bonus depreciation, meaning that us as accountants had to track two different schedules. We had to track federal depreciation and we had to track Oregon depreciation. So, I mean, from our perspective as professional service providers of tax services, we prefer things to be simpler, as simple as they can be for what we do. It takes less time. It keeps our clients' fees a little lower. But when when Oregon decides that they're going to lose out on too much revenue if they actually do what the federal government does, then things get more complicated for us. And so they have, right now the Oregon law says that we're connected to the federal law as of 12/31/2016. So we're waiting until this session gets over with and they actually pass some sort of law as to what they're going to reconnect to find out where Oregon stands as it relates to this bonus depreciation, accelerated depreciation that Dale was just talking about, as well as what they're going to do with this pass-through deduction, or even any of these things. They could just say that they're too expensive for Oregon, and we're going to use it as a revenue raiser and do something different. So just keep that in mind, that while you may get a benefit here on the federal side, your people may not get as big a benefit on the Oregon side. Yeah.
You find any other state besides Oregon that's kind of going off the beaten track? Is there any other states in our republic?
Oh, many states, actually. Yeah, California is notorious for doing their own thing. They're their own government. I mean, they're their own nation, right? Yeah, it's Texas too. Well, they don't even have they don't have an income tax. So, but yeah, California, they have never gone with accelerated depreciation. I mean, their Section 179 expense is still $25,000 a year. So and then they don't connect for bonus depreciation. Illinois, I mean, Indiana, I mean, a lot of the states don't buy into bonus depreciation. So, yeah. So now we're talking about this 20% pass-through deduction. And this one, I think it's probably one of the more confusing parts of the law. The other thing I want to say is that there's not a lot of guidance out there. As you know, I mean, this is just I mean, it's a very long, a lot of things that have changed, but when we ask questions, we don't know the answers. So, I mean, some of these things we're still trying to figure out. We're trying to make sense of. The IRS can come out with regulations, but they've also been told by the president not to come out with regulations. So, because it's too confusing when they come out and release more regulations. So, while we talk to them and try to get some guidance, they have to decide how they're going to give us guidance and how they're going to actually interpret some of these things. If we can kind of skip through the words here, I think it'd be easier if we just went to the chart. And this is kind of a chart of how it works, and you've all got this in your handouts there. But up on the screen, you kind of start up in the top left corner, and then ask yourself, is this a service business that you're involved with? And if you are involved with a service business, so just to be clear, this doesn't involve anybody that earns a wage. So anybody that earns a wage and that's all that they do, they don't qualify for this. But anybody that operates a business where they, even if it's a Schedule C type business or a sole proprietor type business, they would qualify, as well as holding real estate as a business can qualify for this. So you start up in that top left corner, but you do have to ask yourself, is it a service type business? And if it is not a service type business, then you can go over to the right. But first off, we're going to say that it is a service business, and we're going to go down to the bottom here. To the next one, to the lower left is taxable income over the threshold of $315,000 or $157,500 if you're single. All right, so $315,000 for a married couple, $157,500 for a single individual is the maximum amount where everybody qualifies. Yes. That is taxable income. Yes. So the question is if I'm married and I have if I've got a spouse that has if your spouse if your spouse has a $300,000 W-2, you can't make more than 15. I wouldn't change it. Yeah. You'd still have a better result. I think it's better to have the 300,000, but yeah, that's kind of the way it works. So but it's not a cliff. The 315 isn't a cliff. It's a phase out. So I'm not going to get into the calculation because I don't know whether I understand it yet, but it goes from 315 to 415. So anywhere between 315 and 415 for a married couple, you'll get something. All right, if you're a service provider. Right, so that's kind of your limit, but there are opportunities to plan around this. You know, I mean, if you think about it, if let's say you're a service provider and you've got a partnership or a sole proprietorship, I mean, there could be some pension plans that you know that would reduce that. You know, your health insurance costs reduce that. So there's opportunities to look for things to reduce what your overall taxable income is. And sometimes, you know, a pension type plan might help if you haven't been doing that. It would if you had your own like solo 401k or you had a 401k plan in the partnership, that does reduce your taxable income. So if you're getting close to the border there, yeah, I mean look at increasing some of what you do for other deductions elsewhere. All right, and then, okay. So then you could work down to the yellow box here. Is taxable income over the full phase-in, which is $415,000. And I'm sorry, but I don't recall what the individual full phase-in amount is, but it's probably $50,000 over the 157. And then there is no deduction. So that's what you've kind of been hearing about probably is that service providers don't really benefit from the 20% deduction, and that is true. But it's service providers that are more successful than other service providers, I should say. So it's an incentive, I guess, not to be as successful or to get into some creative planning. Don't make too much money this year. All right, and so then if it's not a service, you go over. Then you get into the rules on wages and real estate value. All right. So if it's all right, so let's go back over here to the other blue box in the top middle. It says is taxable. So it's not a service business, but is taxable income over the threshold. So if it's a manufacturing business, a real estate holding company, then it's not a service business, so it does qualify no matter what, right? But so you don't have to implement any rules, I guess. You don't have to look at W-2 wages. You don't have to look at value of real estate if you're under the 315, 415. But then as soon as you get over that threshold and you're not a service provider, then you look at the kind of the pink box at the very bottom, which is qualified business income is 20% or the greater of W-2 wages, 50% of W-2 wages, or there's a third test, which is W-2 wages times 25% plus 2.5% of unadjusted basis of real estate. So they put in this. simplified rule.
Is this available on TurboTax yet?
Yeah.
I think
Yeah.
I think what this really says is you've got to do your planning today.
Yeah.
You can't wait till the end of the year.
Right.
And just to kind of simplify, clear it out here a little bit is that if you're in the service industry and you're below the 315, you're fine. If you go over 415, you don't get the 20% exclusion. If you're a business, a manufacturing business, retail, real estate holdings, whatever it might be, that threshold is still there, but once you go over that threshold, then you have to go into that extra calculation that Rob is referring to.
Right. And I can kind of show it a little bit on the next slide.
Yeah. Got a
go
question
ahead.
over here, Rob.
Yeah. No, that's so the question was if I get $300,000 from real estate holdings and $300,000 from being a broker, I get nothing. I think the rule there is actually going to be that you look at this and you say, okay, am I a service provider? Well, yes and no, right? And am I over 415? Yes, because I'm at 600. So then I have to look at this rule here, and $300,000 of it, I could look through it and look at the value of the property, and I could then take either the lower of 20% of that income, the $300,000 from the non-service business, or 2.5% of the unadjusted basis of the property, which is the purchase price of the property.
Land and building.
Yes. So 2.5%.
Okay, so for the holding company, you would still.
For the holding company, you would still get 2.5% of the value.
That would be part of the calculation.
But it's still a test, so you have to take the lower of all of the numbers.
So each year could be totally different.
Yeah.
Does it make sense then to like?
It does make sense to bifurcate or to move into two different businesses. If you do lots of things in one entity, it really makes sense to move the service and segregate it into its own business.
What if your real estate holdings are just in your own name and not in like LLCs or S corps?
Same treatment.
Well, yeah, it probably doesn't have to be in its own separate entities.
Because it's all passing through, it's down at the individual level. It may come through from a K1, it may come through from a Schedule E or a Schedule C or whatever it might
But
be.
there are still some unknowns in how this is all going to, like when we don't know how the forms are developed yet. Sometimes that actually will drive how things get reported by how they develop and produce the forms.
Okay, so the real estate holding company portion of all of our income, there is a little bit of a benefit.
Yeah, there probably would be.
It's a case-by-case basis.
And we'd, you'd have to look at the whole thing altogether. to
Yeah,
see.
we're doing these calculations now with our clients and looking at their entity structure, using 17 numbers, projecting out what they think are what their 2018 projections look like, and then running it through and saying, okay, what does it look like and where should we be here? So,
Yeah, I mean, I did a tax projection for a client of mine that has a manufacturing business. Been just a family business that she's had for a long time, and she while she pays more regular tax, because they've also, one of the things, I don't know whether we're not talking about AMT, are we? No, in here? I don't.
not yet.
Yeah.
At
Yeah.
the end. At
Okay.
the end.
So anyway,
yeah.
so AMT,
Yeah.
they've reduced how much gets taxable at the alternative minimum tax level. So many people may have, when you're working with your accountant probably has bemoaned the fact that, oh, sorry, you got stuck in AMT this year. That there's still AMT, but it's going to be less impactful on people's returns. So this projection that I did for the client, she doesn't have AMT in this projection, but she pays more tax, more regular tax, but less total tax. So her total tax went down by $3,000 on the federal return, but her regular tax went up by about $3,000, meaning that she was paying $6,000 in AMT in the past. That kind of makes sense.
Yeah.
Just confuses things.
Just one other example. Rob and I looked at a manufacturing company that's a C Corp. And we just picked them up as a client a few months ago, and very successful, privately held company. And there were a number of reasons they liked C Corp. but we're not big C Corp fans for a number of reasons. And but in this particular case, we had another, I guess, opportunity to take a look at it again and talk about what is better, a C Corp at 21% rate or an S Corp, maybe at a 37% rate, but also the benefit of the 199A deduction. And so in that analysis, it worked out to be about the same from a tax standpoint, but the S Corp gives them so much more flexibility as they move forward and they start thinking about an exit strategy of how they're going to get out of this business and liquefy it. So the entity structure, and everybody's saying, well, now we should be a C Corp because it's 21% rate. Well, I'm not sure that's the best place to be. And again, it's a case-by-case basis, but C Corps end up with double taxation unless you're really growing and you don't see in the near future that you're ever going to take excess cash out of the business for your own personal benefit. It's always going to be retained and invested back in that business.
Right. A C Corp makes sense if you're leaving the money in the company. But if you want money out for yourself, it's not such a good deal.
Yeah.
On the next slide here, it's just kind of a real rough example on entity selection. And this has to do with, let's say you're set up as a sole proprietorship, you don't have any, or a single member LLC, and you're not in a service business. This example kind of shows a little bit about how that 20% deduction works over, when you're over that $415,000 threshold. So in this case, you can read through the example, and they have $1 million of income as a sole proprietorship or as a partnership. But if they set up an S corporation in this case, and then they took out a reasonable salary from the S corporation, it's applied against, we think, we're not always sure whether this is going to work, but this is kind of a what if scenario that could happen is that they would get a 20% deduction on $700,000 if they changed their entity structure as a possibility. So, but this is a very specific circumstance, and we're not still certain. We're sure that makes sense if it's allowed. We're not, like I said, not sure what the government's going to come out with as guidance.
And really the only difference here is that as a Schedule C sole proprietorship, which a lot of you guys probably are, you don't take wages, even though it's taxed like wages. So it walks like a bear, it talks like a bear, it growls like a bear, but it's not a bear. So you just change your entity structure and you have to take wages, then this kicks in. So,
sure. Yeah. Maybe.
Maybe. Temporarily.
Right.
Yes?
You stated earlier that the president doesn't want these regulations or what
No, when he started out in the presidency, he made a statement. He told the IRS not to. He said, for every regulation you distribute, you have to take 2 back. He's trying to simplify it. He was sending him a message, but I think they've taken it literally. I mean, they can send out notices and other things, but when it comes to like an actual regulation, then they have to really think hard if they're going to issue one. And maybe in this case, it'll rise to the level of issuing a regulation. It was an executive order, so I don't know how much they have to follow executive orders.
Where do you, how are you going to answer the questions?
Time will tell.
Yeah.
Literature, yep.
Yeah.
And through codification of all the code sections and
people like Jonathan who are reaching out to the IRS. There are people in our industry that are reaching out to the IRS for guidance, and I'm sure once we get beyond tax season, so right now in tax season, it's starting up and we're trying to get tax returns filed, but we can't file all of our tax returns right now because the IRS still hasn't approved 2017 forms, not all of them. So we're waiting for approval from them. So they're working on 2017 because some of these changes to some of this tax law actually do impact 2017 tax returns. So they've had to go back to the drawing board and rework some forms, and they're not finished yet. So as soon as they get finished, with 2017. Then there'll be processing 2017, and then maybe they'll get to working on what things are going to look like in 2018. So we expect to hear more by the fall, hopefully.
I think this is an opportunity.
Hopefully before then. Yeah.
I think this is an opportunity. If we never had regulations, then it's our interpretation of what the code says, okay? And regulations come about by different parties, different interest groups coming together and figuring out what the hell they really meant. And who's writing the law are not practitioners, they're college students, okay? So you got the blind leading the blind. And so if we get through to April of next year, we have no regs. To me, that's a great opportunity to be aggressive. Because they have no case law, they have no regulations to tell me I'm wrong. Now I can't be off in left field, but it gives me a lot of opportunity to be more creative within the boundaries that we have, or the lack thereof of boundaries. So.
Dale's got a great point on that, because if there is no guidance, there is no guidance. It's really that simple.
And you interpret it to the best of your ability.
Yep.
Great point, Dale.
Yeah.
Anything else on this pass-through entity thing that you've been hearing about in the news? Is it clearer? Muddier?
Clear as mud. Yeah.
Say, Rob, would you suggest this is probably the biggest uptick in activity that you've seen earlier in the game? It is certainly for us, but we're finding that clients that never extended before are extending for us in 17. What is it like for you and Dale, books of business, and your team members? You find that the interest in tax year 17 started early for us.
Yeah, it did.
Yeah.
It did. It started early. It started in 2017.
Yeah.
I mean, normally it doesn't start until 2018. The next year.
Right, exactly.
But there was a lot of interest at the end of the year after it passed, and of course while they were talking about it. And then there's been a lot of interest in early filers this year too. And so it's a little frustrating in that we don't have all of the forms finalized for some people, because a lot of people are really concerned about identity theft with the Equifax deal this last year, and so they want to file early. And the news keeps telling them, file early, and we're like, well, we can't. We'd love to.
And just to expound on that, the one reason why people like to file early is they're not managing years, number one. Number two, they think they overpaid, which if we work with them, we try not to have that happen, but sometimes things change. But
you can do more planning when you extend.
When you extend. So, but the other issue is IRS now can hold your refund for 180 days, no interest. And we have seen that happen over the last 2 or 3 years. But now it's part of the law that says we don't have to give you your money. We have situations where you have a refund and we apply it to the next year. Okay? It's taken them 2 years to give us credit on those returns when we have carry forwards. So now we're paper filing returns trying to get IRS caught up because they're telling us that credit never got applied to the next year, therefore you're delinquent on the next year because we're not giving you credit for the previous year. I don't know if any of you guys have experienced that, but I mean, we're talking, we used to think if it was over 6 digits that's where they're holding these. But we're seeing it with $20,000. And people are going, where's my money?
How do you know if the credit from, like, let's say, last year was
You can go to your transcript, or you'll get a love letter.
You'll get a notice from the IRS if you're not getting it applied, or you could try their online service, which is sometimes okay. Yeah. Oh, and so I think Dale mentioned earlier today. I mean, do you mind if I talk about that next thing there? So this was like an Oregon sneaker wave, in that in this bill they also said that meals are no longer deductible, or no, it's entertainment. Sorry, didn't mean to scare you. It's entertainment. So that's what Dale was talking about when he said golf is no longer deductible. So one of their, one of their pay-fors item in order to make this thing go through with the deductions, the additional deductions, was to get rid of the deduction that business owners and businesses had for entertainment activities.
When we originally looked at the bill, it was buried.
Yeah, it was buried.
It was buried under miscellaneous employee fringe benefits.
That's what they called it.
Like laser ticket?
Yeah, 0% deduction.
Concerts, skiing,
Super Bowl.
Super Bowl.
The meals component's still 50% deductible.
Still 50%, but not the ticket. Depending on what your receipt says, you're good to go.
Yeah.
What do you want to call it? We're going to have to be really creative.
Yeah. So the and you also used to get a charitable donation to a foundation for the right to buy season tickets for college events, and that's also gone away as the deduction.
So if you have any clients that have entertainment venues,
yeah.
So I think it's going to have impact. We've got clients that are, they're not hurting for money, and they're making decisions to get rid of their Mariners tickets, Seahawk tickets, Blazer tickets, college. I mean, I don't know. Yeah, that's right. Yeah. So yeah, it's going to be pretty dramatic. When we first heard about it, we thought it was business meals as well.
Yeah, we thought it was meals and entertainment because it just said because it's under that whole section of meals and entertainment. But they just really axed the entertainment side.
So, and then to follow that up a little bit, you have a company Christmas party. Used to be 100% deductible. It's only 50% now.
And so, yeah, company function meals were used to be 100% deductible are now 50% deductible.
Uh-huh. Sure, the rental of the room, sure.
Yeah.
Sure. Yeah.
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 It's rent.
It depends on how the Mac Clubs gives you the invoice. And so now take the Blazers, okay? You go there and you say, okay, well, I'm going to pay $1 for the ticket, but I'm going to pay $200 for my hamburger. Well, what if I don't buy a hamburger? Are you going to really sell that seat for $1? So the ability to shift things around in this entertainment industry is going to be pretty tough.
There's a question. Isn't client gift still at $25?
Still $25.
$25 a year.
Per person, per client.
That's the rule. It's been there since like 1940. Oh, 86? Okay.
I started in 81 and it was
$25. They haven't adjusted it. I mean, but it's not to say you don't have a promotional expense, instead of a gift.
Yes.
It has to do with they have to make it fit within a 10-year budget.
10-year budget.
So it has to sunset, and then they have to decide whether or not to extend it. Just like what happened with Bush when he had some tax cuts, and then it was only a 10-year provision, and then Obama administration continued on with some of it for a while, and I think today we still have the 15 and 20% capital gain rate. From that original tax cut years ago that was originally just a 10-year bill as well.
Go to the last page. I think we're taking up a bunch of your extra time, so in the spirit of moving on, we'll be around for questions afterwards, but we'll just touch on the estate rules are nice. They've doubled those up, so that's good. Right church, wrong pew? Okay, so the estate rules. And then we've got some miscellaneous things on the back talking about alimony. These are pretty easy to read. I don't think I need to go into a whole lot of detail on these. But these are just some of the things that have happened that are pretty simple to take a look at, but how things will get calculated and how your itemized deductions will be affected. No personal exemptions anymore. No ability to deduct your investor's fees. No way to deduct your accountant's fees. That's why for years and years, even with this rule being there, we bill 90 to 95% of our, close the door, individual returns through the business. Because most of the time it has to do with the business, okay? And so, but those are huge as far as when it comes down to, think about a professional athlete who has a $10 million contract and he has a 4% commission to his agent. Can't deduct it. So they're getting the screws put to them. Not to say they can't afford it, but that's kind of where the gravy's coming from to try to support all these other changes. Is there anybody in here that does not know about the limitation on state and property tax deductions? Is anybody happy with that? Yeah. They put the screws to us on that one. It's huge. Huge. Big numbers. And a lot of states tried everything they could to work around it. And some state, I think New York, New Jersey, Connecticut are trying to sue the federal government about that. So. The state, yeah. Property taxes, state income taxes. Interest? Okay. Interest, and I think that's in here also. I think I skipped over it. For primary residencies, after beginning to 1215 going forward, if your loan's more than 750, you only get to deduct that proportionate share. If you have a $1 million loan, you get 75% of your interest deduction on Schedule A. Yeah, and no HELOCs, no equities. It used to be 1 million plus 100. Okay, so what that means is the cost of your capital is going up. Okay, your after-tax cost of capital is going way up. So again, as you guys start seeing inflation in the marketplace, that inflation, obviously there's a number of factors that drive real estate. One is the tax rates and the interest costs, right? So in your carrying costs, so at that point, what is my true effective interest rate when I only can deduct a portion of my interest? Okay, and I don't know if that's going to affect primary residencies and how quick they turn. I do know the 1.1 million didn't slow too many people down, but now you have a situation where you have a real good market and prices are high. So 750, what's the average price for a home now? 5.5, 6?
4.25 right now in Portland, but
4.25.
Close in West Side, average price is $1 million.
Yeah, so just an average home.
Yeah.
So we'll be curious to see what happens on that side of the fence from a banking and from a primary residency standpoint. Big down payment, yeah. Okay. Any other questions? Thank you guys for your attention. We'll be around. And until next time, happy trails.